Bond is an instrument or debt instrument. Debt instruments issued by corporates to individuals, corporations, other corporates here, other corporates, and even governments. Okay, it is a debt security. You remember in your balance sheet, you have on your liability side, you have debt. Here, this is liability and equity. Here, you have current liabilities, long-term liabilities, and shareholders' equity. Okay, this is a portion where you show the bonds. Okay, under liabilities and equities, you show current liabilities, long-term liabilities. This is the debt portion. In the debt portion, long-term liabilities is the place where you show the bonds. Bond is issued to individuals. Bond is issued to the other corporate companies. Bond is issued to other government or government, state government or central government. For what? To raise the capital. This capital becomes debt capital and this capital becomes equity capital. So bond is a debt capital. Debt capital which carries interest charge. So example, we are issuing, okay, we are issuing 1000 bonds of 1000, I'll write here 1000 7% or 8% bonds of $1,000 each. Okay, here this is the title of a bond. You will have a title here on the bond, okay, with a company seal and all, and the title should go like this: 1008% bonds of. So here debt amount is going to be, how many bonds are issuing? You are issuing 1000 bonds. I will change this to, I'll change this to 2000 better, so that you will not have the similar number. 2000 bonds times $1,000. Clear? So the debt amount is going to be 2000 times 1000. How much is that? 2 million. $2 million. This is the amount you are going to show in long-term liabilities. This is the amount you are going to show in long-term liabilities. What is the interest amount you are going to pay? Interest is going to be $2 million times 8%. Okay, that is 2 million times 6%. This is the amount of interest. Yeah, 2 million times 6%. So say 8%. 8%. $160,000. Yeah, 1.6 million. 8%. No, 8%. 160,000. Clear? When bonds are issued, the entry would be debit bank account. How much is the amount? 2 million. Credit 8% bonds account. You can mention that, 8% bonds, 2 million. Okay, so this amount is recorded at the time of issuing the bonds, at the time of issuing bond. Then each year you are issuing, for each year, interest expense, debit debit, interest account debit, and bank account credit. That is 160,000. Okay, you will be paying this interest during the life of these bonds. These bonds can be issued for 3 years, can be issued for 5 years, can be issued for even 10 years. There were 30 years bonds also. Recently, the 30 years bonds are discontinued because most of the people they start investing from 30th year or 35th year or 40th year, and the length of the bond is say 30 years, so you do not have any flexibility of utilizing that money, and by the time the investor will reach 70 years age, so there is no good demand for 30 years bond. Now most of the bonds exist from 5 years to 15 years. Say for example, the duration of the bond is, say for example, this is the time period during which the bond issuer enjoy the bonds amount and pays annual interest. So this 160,000 is to be paid 5 years each year because the bond life is say 5 years. So each year you will have to pass this entry, and each year your income statement will have an expense of 160,000. This is where this is where you will have a finance cost. You remember in your income statement you have EBIT minus I. This is a portion hits your EBIT minus I equals to EBT. So when we have bonds, you will have interest burden as well. Clear? So 5 years you will pay interest. Fifth year, okay, that is called redemption of bonds. Okay, at the end of bond life period, the issuer has to pay the bond amount to the investor who invested in bonds. So the investor will come back, hands over the bond to the corporate, and will ask the money to be paid. This $1,000 is to be paid. It is same like a loan, how you give loan to somebody will pay you interest on yearly basis, and when you want to get your principal back, that is called redemption, repayment of loan. So at this time, redemption, the entry would be reversed. This entry would be reversed. Simple. 8% bonds are redeemed debit because here it was credited, it's a liability. Now liability is waived off because you are paying it back 2 million. At the time of redemption of the bonds, the entry is to be reversed, but you keep this money ready in the fifth year if the bond period is 5 years. During this 5 years, you don't need to worry about the repayment. You'll have to just worry about only the interest. This is a great advantage to the corporates that for time period you can arrange this money by just paying only interest, so that these bondholders will not share your profits. Whereas if you issue shares, lifelong the shareholders will enjoy the profits. This is the reason why you maintain a capital structure, an optimum capital structure, okay, which will give you benefit between equity and bonds, or equity and long term debt. Long term debt can be repaid when you have enough cash, you can repay it. But shareholders equity, the shares cannot be redeemed. Shares will be there forever. The common shares will be there forever. So as long as the company exists, the shareholders will get dividend, which is a part of the profit of the company. But in the case of bondholders, it's not like that. During the life of the bond, they will enjoy the interest. Once you have money and redeem it, there will be no interest burden, and there will be no bonds at all. So no interest burden, no sharing of profits. Here, face value of the bond. Face value of the bond is also called as par value. Par value. The registered or the legal value of the bond is called face value. See, here you will have the bond value here. Here somewhere it has to be printed that the bond value is $100. Bond value is $1,000, right? Example, this one. Where is that? Here. Okay, here the face value is bond is $1,000. Okay, so this bond, if the company is in good demand, may be issued at higher price, may be issued at lower price. Clear, right? So premium on issue of bonds. When the bonds are issued at a price higher than the face value of the bond, the bonds are said to be issued at a premium. Premium. Okay. So here these are issued at $1,050. So what is the amount here? The premium equals to 1,050 minus $1,000. Okay, the premium is a profit to the company. Premium is a profit to the corporate, which can be utilized for any other purposes. Clear? But if the bonds are sold at a price lower than the face value of the bonds, then we call it as discount. Yeah. Discount on issue of sales, discount on issue of bonds. When the bonds are issued at a price lower than, then we call them as issued at discount. This 2000, 8,000, 8% bonds of 1,000 are issued at say $900. $900. So here the discount amount is $100. Yeah, $900. Clear? Here when I issue these bonds at the time of issue, so I will be getting this amount, bank account debit, bank account debit. How much is the amount? I'll be getting 200 2,000 bonds times 1,050. Are you with me?
Yes, sir.
2001 1,050. 1,050. So here 2,000 bonds times 1050. 2,100,000. but the bond value is only 2 million. Okay, that is 2000 bonds times 1000, and you are getting a premium on issue of bonds. Okay, this is 100,000, that is 50. So like Super 6 here, how you mention premium on issue of shares, etc. The premium will go under, long-term liabilities itself, this highlighted area. So you will have 2 million as well as 100,000 also. Now, if the bonds period is 5 years, hmm, if these bonds are, issued at 5 years, I'll write here 5 year 2008% bonds of $1,000 each. So this income has to be recognized in 5 years. Clear? So you will be recording this for recognizing the premium. You can recognize the premium if you don't have any other expenses to absorb. Okay, so your premium account will be debited. Okay, credit income statement. How much? 20,000. 20,000.
In which head it will go, sir? In income statement?
Non-operating incomes.
Non-op. Okay.
Non-operating incomes. 100,000 divided by 5 years. Okay, so this amount would be absorbed in 5 years time. This is non-operating income because it is
Okay.
not the income generated from the operations of the business.
Okay.
Okay, so in addition to this, each year you will have an interest expense also. Remember, I gave you interest expense here, interest account debit, bank account credit, and at the end of the 5th year you will have this entry. Okay, so how many maximum entries you will have? 4 entries. Okay, now the bonds are issued at discount. Bonds are issued at a discount. Here there is a loss. What is the discount amount? The discount amount loss is, say, what is the amount at the time of issue?
2 million.
Sorry.
Bank 2 million.
Okay, at the time of issue, you have 2 million, oh sorry, 2,000 times 900. That is 1.8 million, 1,800,000. Clear? You have one more entry on the discount debit side because it's a loss. Discount on issue of shares. Discount on issue of bonds. On issue of bonds. How much is that? 200,000. 200 or 100? This is
100.
issued at 900, no? Yes, 200,000.
200,000.
1.8 million, 200,000. 8% bonds, 2 million face value. And
That is not required.
it is not required because it's not a premium. Okay, so you have a loss of 200,000, but the bond period is, say, 5 years. 5 year. Bond period is, say, 5 years. So the discount on bond is to be recognized as an expense, non-operating expense. Non-operating expense in 5 years. Clear? So income statement is to be debited and discount on issue of bonds should be credited. Each year you will have Say how much? $40,000. 5 years, $40,000 will make 200,000. Clear? Yeah.
Yes.
Is this clear?
Yes, sir.
Each year you will have non-operating expenditure. This is the reason why this amount is to be added back in your cash flow statement under operating
Yes.
activities. Hmm? And each year you will have interest expense and the redemption entries. Anyway, they are there. You'll have to record this. Here also you will have 4 entries. If you issue the bonds at a discount. Clear? Yep.
Yes.
This is called present value concept. If you have $1,000 today and you have an earning capacity of 10%, you are going to get $1,100 at the end of the year. If I give you future value, that 1,100 at the end of the year, what is the present value of the same? If I give you this percentage and 1,100, you can get it back. Take your calculators. It should be like this. To calculate present value, future value divided by,
100,
okay.
100,
In fact, you should do this way.
100 plus
Future value into rate divided by
divided by 5
100
plus 1,
plus rate,
10.
rate, the rate percentage, yeah.
Yes.
So it is like this, future value 1,100 into, what is the rate of interest here? 10%, right? 10% means 0.1 divided by 1 plus r, no? 1 plus r divided by, not 100 plus r, it is 1 plus r. Yeah, divided by 1 plus 0.1. R means 10%. 10%. Yeah. Can you calculate for me, please, this area? Yeah. 1 divided, say here it is, rate is 10%. So 10% is nothing but 0.1. 1 divided by 1.1.
Upper factor should be 1. No?
It is 1, I think, right?
1.
1 only. 1 divided by 1 plus r. Yeah. 1 only, not r. Yeah. Yes, please. What is the
Get
value?
1000, sir.
You will get 1,000,
1000.
approximately 9999 something, 1,000. That's it. This is what you can know using the present value tables. Can I have the value of this 1 divided by 1.1, please? It should be, I think, point zero point zero 0.909. It should be like this. Clear? Here, once you know the present value, that at 6% it is 0.747. Now let us apply the same in our calculations. Here 1 million, 1 million times 0.747, that is 747,000. So the amount of 1 million which you are going to pay at the end of the year is equivalent to 747,000 today. Like in my example here, 1,100 at the end of 31st December is equivalent to $1,000 today. That is present value. Likewise, the amount which you are going to pay at the end of fifth year is equivalent to 747 today. And each year you are paying interest on bonds. you are going to pay each year. When you use each year, you should use annuity table, please. Annuity table. Okay. When you are paying a fixed amount, same amount each year, you'll have to pay as per the equity. What is, oh sorry, annuity. What is annuity table here? Annuity table says, annuity table. Let's go to the annuity table. Present value of annuity. Present value of annuity for 6%. What is the value here? 6% here. 6% annuity table. Annuity table 6%, 4212. So each year you are paying 80,000. That should be multiplied with 4212. How much interest you are paying? 336,960. In actual, for 4 years you are paying 300 and how much? Oh, sorry, 5 years you are paying 400,000. But the present value, if you calculate, it is only 336,960. So the total amount, the value of the bonds is 1,083,960. But you are issuing it 1 million. So the remaining amount is called as premium. You should calculate this way. There might be an MCQ, please. You should always remember, on the bonds you should calculate the present value, and on the interest you should calculate annuity. Now I am going to show you how to check the present value and future value, sorry, annuity value, using your software. Okay, check here. As per the maturity plan, as per the maturity plan, you have the bonds. The term bond has a single maturity date. Means you say 5 years, only 5th year the bond will be matured and the amount will be paid. Okay, so you will have a term, a particular year, 5th year or 6th year, like that. On 5th year or 6th year only, you will be paying the dividend bond amount. A serial bond is a big issue to the issuer as well as to the investor, because a serial bond does not have any fixed retirement date. Even if the investor wants money, he will come back and ask you money. Or if the company is having money, you can call the investor and pay it back. Okay. Next, repayment provision. Based on the repayment provisions, bonds are categorized into income bonds. Income bonds pay interest only when we have a sufficient income in our company. So there is a clause which will safeguard the company, that if the only company, when company gets a good amount of profit, then it will pay interest to the bondholders. Okay. Revenue bonds. Based on the repayment provisions, the revenue bonds. Revenue bond title says only when a company makes appropriate sales, then the amount would be paid to, the amount of interest would be paid to the bondholders. Based on the securitization. Securitization means a bond will be collateral with some assets of the business. Means the assets are mortgaged on the bonds. So when that, at the time of issuing the bonds, the the corporate company notarize the assets of the corporate against the bond amounts. So each and every bondholder will have some a sort of asset, a right on the asset of the business. So it could be land, it could be plant, it could be machinery, etc. So you will have complete security. Okay. Whereas the debentures are backed by borrowers' general credit but not by specific color. This is very important as compared to Indian debentures and US debentures. In India, we call debentures are fully secured instruments, but here these are not secured instruments. Okay, only debentures will be given second priority after the mortgage bonds. Guarantee bonds are guaranteed by third party. Example, the parent of the subsidiary company. If you give any guarantee of any one of the group companies, okay, yeah, that is also called a securitized bond. or collateral trust bonds, trust or equipment trust bonds, wherein you will have equipment is given as security. That's what securitization means. You will have mortgage on land and building, property, plant, machinery, etc. Valuation. Based on the valuation, the bonds are classified into like rate will change from time to time. Like when I mention 8% here, may not be 8%, it will be 9% next year. That is floating rate. Okay. So in all the cases, we mention 8% or 6% fixed here. In this case, it may not be 6% fixed. It will vary from time to time. Zero coupon bonds. Zero coupon bonds or deep discount bonds. Important please. Say for example, zero coupon bond means today, if the bond value is $1,000, I will issue this at $800. And after 5 years, you come back and get your 1,000. This is called zero coupon bond or you know deep discount bond. There will be no interest rate mentioned here. I will sell an instrument of 1,000 today, but I will collect from you only 800. After 5 years, you come back and get $1,000. Means I don't have any interest burden each year. That is the reason why I'm collecting only 800 against an instrument of 1,000. It means that I am giving you an instrument of $1,000 that I will pay for $1,000 once you present this at the end of fifth year, but you pay me only today $800. The $200 you can say that interest, you already deducted. Commodity backed bonds. Commodity backed bonds means on the assets of the company, same like your equipment, land, etc. If you have any commodity like valuable items, precious material on which you will have right if the company goes into liquidation. The next type of bonds is redemption bonds. Redemption means callable bonds. At any time, the issuer can call the amount. Same like here. What is that? We have one bond, no? Serial bonds. Serial bonds do have maturity date in different dates. So here callable bond means any time the issuer can call you that I don't want any bonds, now I'm paying you back. No need to wait for 5 years. Say third year you are having full money, you can pay them back. Okay. Convertible bonds. Later at any time these bonds can be converted into either common shares or any other kind of instruments. So the title should say convertible bond. So please try to remember the terms based on maturity, based on repayment, securitization, valuation, redemption. You don't need to know these headings, but at least you should know what is a zero coupon bond, what is a callable bond. One question would be asked from this place. One question at least. Okay. So try to please concentrate on this.